In today's video, we are looking at my trading journey towards becoming a profitable trader. This is the day one for YouTube. Now, I'll put my introduction in the YouTube description, and I don't want to bore you with, boring stuff. And I just want to get into good stuff. I want to share my knowledge and my journey with you guys. So, what am I going to be covering today? I cover my risk management rules. I cover my insights on various tools, and I cover my demo trades, which I took on TradingView. And hopefully, both you and I will get to learn a lot from it. Let's start with what makes the fundamental basis of my trading, and that is the trader's equation. And I think if you don't know that, you can't be a good trader. So, what does the trader's equation state? It says probability of winning times the reward should be greater than the probability of losing times the risk. This gives a positive expected value, which is a statistical concept. So do have a look there. In fact, I can make a video should there be sufficient interest. Now, an example is you risk $10 for 20 in reward, and the probability of winning the trade is 40%. Should you take the trade? Well, let's look at the next slide. Not this one, but this one first. You risk 10 for 20, winning percentage is 40. Should you take the trade? The answer is yes. You should, but only if you're going to trade the same setup sufficiently large amount of times. And what's the reason for that? The reason is that if I were to take just one trade, for example, most likely I would lose the trade. And this is because a statistical distribution has some variance. If you're not a stats guy, this is just saying that if you were to roll a dice 6 times, on an average, you are likely to see 1 6, but sometimes it may take 7 tries, sometimes it may take fewer tries, right? So the thing is, if we do, let's say, a dice roll 100 times or some large multiple of 6, let's say 66 times, then on average, we are likely to see 11 sixes because probability of getting a 6 on a dice is 1 over 6. So, you roll dice 66 times, you get 6 sixes. You get 11 sixes. Sometimes you may get 9, sometimes you may get 12 or 13. So, because statistical distributions have some variance, but as the number of rolls increase, or as the number of trades increase in our case, that variance starts to disappear. And what we converge towards is the average. So, what is the expected value for this trade? Well, according to trader's equation, it's 20 times 0.4. 20 is our reward, 0.4 is probability of winning. Subtract the loss times its probability, and that gives you expected value of per trade, which is 2. And of course, if you have a set take profit and stop loss, you cannot win $2, but over 100 trades you can expect to make $200 on average. That's the point. It's not about per trade, it's about over a large number of trades. So this is what I follow when I'm taking a trade, and I have a setup. So that's quite useful to know. One more thing is, getting onto this slide, is if you lose 10% of your account, this is what I've learned. If you lose 10% of your account, you need 11% to break even again. You don't need to make, you cannot make just 10% back and be expected to break even. You would need 11%. You can do the maths for it, and it just works out. And if you lose 15% on an account from the first trade, you need to make 18% to break even. And so on for the other numbers. You can pause the slide, have a look. And with that, let's move on to the next section. These are my risk management rules, which I'm following right now. I'm just sharing my knowledge, my journey. If you disagree with certain things, do let me know. I'm open to criticism. So here is what I have. My risk management rules. 1 to 2% capital per trade. Close the trade as soon as it's invalidated, and minimum risk to reward ratio 1 to 1. Well, ideally, it is recommended that you should have 1:2, but currently I'm not in the stage where I'm easily able to find 1:2 trades or 1:3, 1:4. The thing is, when you try to make a trade which has a risk to reward ratio of more than 1:2 or 1:3, you are saying that, let me get a pen. You are saying that for every 1 unit up, let's say I'm shorting the stock, for every 1 unit up, I'm risking I'm not risking. I want 8 units down. So my stop loss is here and my take profits is here and the price is here. So the price is more likely to move up than move down by 8 units. Yes, it can move up by 1 unit, but moving down by 8 units, that seems a bit rough. No, even moving by 2 units. Let's say this is 2 units and this is 1 unit. Then this distance is twice x large as this distance. And so when you have a good risk to reward, you may be having low probability. So probability that the price will go up is larger than it will go down. And we are assuming a short position. So short position means I'm betting on the stock to go down, right? So that's the problem why I'm not able to, consistently find 1:2 or 1:3 trades that succeed. But okay, let's get into my insights on some useful tools. So, for example, EMA is something I've found very useful to me recently. I think, especially the 200 moving average, I've seen it taking, uh, being useful as support or resistance. Of course, the traditional support and resistance levels are, of course, useful without any doubts. And I've seen, now, this is a particularly strong insight I've found. Reversal attempts are more successful when deviation from 20 and 200 EMA is in the same direction. So, for example, let me get a different colored pen. If this is my 20 EMA, and let's say this, let me get a different color. This is my 200 EMA, and the price is somewhere here. Then reversal attempts towards either this moving average or this moving average are more likely to be successful rather than if they were, let's say, the price was here. If, let's say, we are coming from an uptrend, the price is more likely to go up straight away. But if it's here and we see some price action in terms of candlesticks towards going down, which may indicate a reversal pattern, it is more likely to be successful when you're above 20 and 200 EMA. This is what I've found. I might be wrong, but this is what my insight is. So that's one insight. The other one is that Elliott wave theory is not wrong, but wave counting is subjective. I'm not going to give you a full detailed explanation on Elliott wave theory because that's out of the scope of this video. And there are plenty great videos on Elliott wave theory on YouTube, so do have a look there. But my thing, what I've understood is that it's not wrong. I've seen Elliott wave patterns form in real life, but this wave counting thing I find to be a little bit subjective. So sometimes when I think we are in wave 3, we are still in wave 1. And so that makes me, get confused and I'm not able to find the best trades. But Wyckoff patterns is what I've been recently studying, and they seem to be working. They are easier to identify at least. There are some great videos on Wyckoff as well by I think one guy called Pro Strategies or something. He's got a great video on Wyckoff, and I think this concept of accumulation and distribution on Wyckoff patterns is definitely something, and especially the concepts of supply, demand, and cause and effect as well. And then you have a return to origin, secondary test, primary test. These sort of terminologies are actually useful, and they're actually seen in the charts. Triangle patterns, these are actually my favorite to trade because I think I have a particularly high success rate with these. Triangle patterns, for example, like a symmetrical triangle or a rising wedge, these sort of patterns, we'll look at them in more detail in my trades. But I think they are quite useful to anticipate breakouts. At least that's what I've found them to be. So now that you know my insights, I'm going to show you one trade I took yesterday night. And this was on BTC. I was scalping. We have uptrend on a daily chart. And this is at night yesterday, UK time. This was what was happening on the 5-minute chart. We have a contracting triangle or a symmetrical triangle, you can call it. Is when the price moves something like that. Well, it's really on the chart, as you can see. I'm going to go into more detail on the zoomed in chart. So we see the market is making higher lows, and but it's also making lower highs. lower highs. So at this point, it is not really clear whether we are in an uptrend or a downtrend. Well, in this particular subsection of the time frame, overall trend on the 5 minute chart was bullish. But when a symmetrical triangle comes, we are expecting a breakout. We just don't know which direction it would be in. Symmetrical triangle doesn't give us that information. For example, a rising wedge more often than not gives a breakout in the short direction. I mean, the price goes down. So here, I had expected three tests. This is usually a expanding triangle or a contracting triangle with say three tests. So I had seen three tests, two tests, and I was viewing the market from this candlestick. I'm going to highlight it with a different colored pen. This is where I was at the market, or maybe one candle before this. Now I had drawn this wedge. There were support levels around this. You have this EMA. This is the 20 EMA. 200 was a bit below. It's not visible on this chart, but it was a bit below. So I enter the trade on this candle. I bought the close of this candle, and I had a particular reason to do so. The reason is that I was expecting to see a third test. It actually did happen. It actually happened like poetry. So this test that did happen, but okay, let's say I only have the view of the market until this point. I don't have any more than that. Actually, let me erase something so that it's easier to see. I'm just going to erase the lines which are not necessary. So I had the market view before this candle. I don't know what happened. I didn't have all this from the right of this candle. But I see this candle closing above 20 EMA, and it closes at its high, and it takes support from the trend line. Now, if I combine that with the fact that I'm expecting to see a third retest on the upward trend line, this one, then I thought it made sense for me to take a scalp with my stop loss set just above the low of this candle. So this was my stop loss, this point. And my take profit was exactly here. Now I didn't get filled on just this candle. I got filled around here, so just close to my take profit. It was actually a little bit more than my take profit. But I thought I had solid basis for taking this trade, but I would like to say that the risk to reward ratio, this trade was only 1:1. One more thing is that I didn't take entry on the 5 minute chart. I looked for precise entry on the 1 minute chart. So this is where I was on the 1 minute chart. And you can see this blue arrow signifies where I took the trade. It's because we had second bullish candle in a row closing above its high, above the 20 EMA. The orange line, as you see, is the 20 EMA. I took the trade here. It started to go up. It started going down, but it took support from the 200 EMA. And now this is why my insight about 200 EMA I think was quite useful. This 200 EMA was useful for support multiple times. For example, here and even here, we closed below EMA, but then we jumped straight after 200. So that's what it was. So I take the trade here, the market starts to go up, but then suddenly I see four bearish candlesticks. I didn't exit my position yet. I mean, it did not invalidate my setup because there was again a support from the 200 EMA. And now we got, so this breakout was actually false, and we got a correction in the upside direction, or well, the correction of the false breakout in the upside direction, and I got my take profit hit here. I think I made $58 on this one. I traded one quantity of Bitcoin. And so that was a quite a nice trade. After that, I lost a trade, but I don't want to make this video too long. It's my first video. But if you would like to see longer videos, do let me know. And I will definitely cover my lost trade in a different video. And hopefully that will have some learning lessons as well. So that's it for today's one. And I'll see you guys in the next video.